Welcome to Global One Media Stocks to Watch. I'm Michael Suido. Our guest today is Adrian Day. He's the author of several books. We'll get to those in a moment. He's also the head of Adrian Day Asset Management. Adrian, welcome to the show.
Well, thank you very much for asking me, Michael. I'm looking forward.
Definitely. All right. Among the books you've written are Investing Without Borders and Investing in Resources, How to Profit from the Outsized Potential and Avoid the Risks. These coincide with your investment strategy, which is global in nature, focuses on value and commodities. Now, there are a lot of value investors out there, plenty of international ones as well. But I'm curious, why are natural resources, why are commodities such an integral part of your strategy?
Yeah, no, that's a good question. And, typically when you look at resource stocks, you would not see them as value stocks. They're certainly not anything that Ben Graham would recognize as a value stock. The PEs, price earnings, can be very high, et cetera, et cetera. To me, there's really two main reasons. One is that commodity stocks frequently, not always, but frequently move in opposition to the main market or the rest of the market. Or at the very minimum, I think we can say that commodity stocks can have strong moves upwards when the rest of the market is not doing well. And so they act as a little bit of a hedge or a counterbalance, perhaps would be a better way of saying it. And I think the other thing is that commodity stocks are one of those sectors. There are several, of course. Biotech's another one, emerging market stocks are another one. But it's one of those sectors where you can have a legitimate expectation for not just doubles, but, what we call 10-baggers. They're not infrequent in the resource business. And so I think, for both of those reasons, I think commodity stocks are a nice counterbalance to a general value approach.
So you're seeing commodities both as a potential hedge, but also as an asset area that can provide significant upside.
In their own right, yeah. And if I may, just a tangent on your question, I think right now is just the most incredible opportunity I've seen in my entire business. And I've been managing money since 1991, but investing professionally, writing on investments since the mid-1970s. This is the most incredible opportunity, frankly, that I've seen for commodity stocks generally, gold stocks in particular. Not only are the valuations just remarkably low relative to, price relative to history, but of course, price is not as important as value. But the valuation metrics on some of the big mining companies are at 20 and 40-year lows. Like Agnico Eagle, the third largest gold mining company in the world, is trading pretty much at its lowest price to free cash multiple in its entire 40-year history. That's astonishing when you see where the price of gold is selling. Anyway, I don't want to go too deeply into, one stock, Agnico, but I just think the valuation is there. And then when you look at the values of the valuations on the gold mining stocks relative to the S&P, again, it's an anomaly to see on many, many metrics, on most metrics, in fact, but gold mining stocks are actually undervalued relative to the S&P. That's very unusual. Got a higher dividend yield than the S&P. And they're net cash positive, which again, for a capital intensive industry is very unusual. Anyway, so not only do I think in general, in principle, there's always a place for commodity stocks of some type or another in a portfolio. But right now, I just think they're the best risk reward out there.
I think it's really interesting to hear you say that right now is such a great time to be investing in gold stocks, particularly. We talk a lot about that on this show, about interviewing executives from different gold mining companies. Really interesting to hear an asset manager like yourself take that view. You talked about fair value, and I want to explore that a bit more with you because there's a lot of data out there, but you might say that the final decision as to whether something is trading at or below or above fair value is really subjective. So as an asset manager, when you're screening a long list of equities, trying to determine what to invest in, how do you identify the ones that are truly undervalued?
Yeah, no, that's a good question because, of course, when people start in this business, they tend to look at price earnings multiples and say, oh, this one's cheap, that one's expensive. But of course, as we know, there's an awful lot more to it than that. And different value investors, I mean, Warren Buffett is a perfect example. Different value investors have sort of adopted the traditional Ben Graham approach to value and taking it, if you like, a step further. The first thing I would say is that I definitely look at the commodity stocks, the resource stocks, in a different way than I look at the broad market. And it's not just commodity stocks. It would apply to biotech stocks and early stage technology stocks and so on. And I think also that there are different, I mean, I look at the same metrics everyone else does, price to free cash flow, price to net asset value, the balance sheet, and so on. But I think different metrics are more important, have a different weighting for me, depending on the sector I look at. So when I'm looking at, again, mining stocks, mining, not royalty companies, but the actual miners or oil producers, then price to net asset value and price to book is really quite important. But in a lot of industries, price to book is sort of meaningless. It's certainly, again, not as important as it was when Ben Graham wrote his treatise back in the 1920s. So different metrics to me are more important with different sectors. When I'm looking at dividend, if I'm buying stocks for the dividend yield, for my investors who want income, let's say the business development companies, well, obviously the current yield is critical, but also what's important is that yield covered by, in the case of BDCs, by net investment income, in the case of other companies by earnings, and is it sustainable? But for a gold mining company or for most manufacturing companies, the yield is a bonus, if you like. It's not the be all and end all. So again, I think
you have different metrics for different types. Sorry, just to jump in, but I get that you have different metrics you're looking at for different types of asset classes. For the gold and mining stocks, you're really interested in that asset value. For other stocks, where maybe you have an investor that wants a recurring source of income.
But I think two things apply to everything. One is balance sheet. Balance sheets are extremely important to me. And I'm not against leverage, obviously. But you want to know that a company has a solid enough balance sheet to sustain its operations, in a downturn. The other thing that's critical to me is management. I like to get to know management to the best of my ability in any sector that I invest in. Now, obviously, it's a little more difficult for me to become chums with the CEO of Nestle, but I still like to know everything I can about the management. I like to follow the management, understand them, read their interviews. I don't just mean the earnings reports, but read who they are and how they think. And with the smaller companies, I like to get to know management. To me, that's an absolutely critical key to everything.
I was looking at your company's investment tactics. They include options, short sales, private placements that provide additional leverage. I got to say, I don't necessarily think of these as being buy and hold value investment tools, even though Warren Buffett has been known to use options. So for your company, where do these tactics fit in?
Yeah, no, that's a good point. So first of all, with options, we rarely buy options. So we don't, I mean, sometimes we do, but rarely do we buy a call, which is more of a speculation on a price and a time. Our most important option strategy is simply selling puts. And I'm a very simple kind of person. I sell a put if I want to own the stock. And so either option is a successful one. Either outcome of that put is a successful. It either expires and I pocketed income, or the stock's put to me and it's a stock I want to own anyway, but I acquired it net of the option premium at a lower price than I would have paid for it anyway. And of course, we don't do that all the time. We sell puts when maybe the price of the stock is just a little higher than we would like to pay for it. particularly if the premiums are high. And as you know, and I'm sure most of your listeners know, option premiums vary considerably. And the volatility of a stock is one of the critical components that determines what the premium you get on an option is. So there's times when the options, selling puts, is just more attractive than buying stocks. And then we'll go for a year or 2 years when we just don't think selling puts is appropriate. But to me, that's really just a very conservative strategy. And to me, it's just an extension of a long-term approach. If I sell a put and it's not put to me, I just sell the put again and then sell the put again and then sell the put again until finally we own the stock. And in the meantime, we pocketed the premium. So yeah, I see that as certainly conservative. Takes a little bit more work on my time, but is part of a long-term strategy. Yeah. And as for shorting, I see that as a hedge.
Okay, really interesting. Really interesting. Thank you for walking us through about selling the puts and how that can actually be conservative. That's fascinating. I want to talk about risk and reward because generally there's a trade-off between the two. We know that the riskier the investment, the higher the potential return it should offer. When we look at what your company offers, it's global accounts. You have what you call aggressive plans and conservative plans. And at first glance, it seems like the major difference between the two is risk appetite. So how do you measure that? And what would be an example of a more risky asset that would be in the aggressive account, but not the conservative one?
Yeah, no, that's an interesting question. And we get that a lot from prospective clients as well, of course. The first thing I always say is there is a difference between volatility and risk. And, most people confuse the two. Even if you look at modern portfolio theory, they look at volatility and call it risk, but it's not risk. Risk is the possibility of a permanent impairment in capital, whereas volatility is just something that may change next day, next week, or perhaps next year. So volatility, I don't mind. And, so long as, and I talk to the prospects and the clients about this, if you have the financial wherewithal to withstand volatility, and you have the psychological characteristic or framework, if you like, that allows you to accept volatility, then volatility is your friend. It's not your enemy. It allows you to buy things when they're much less expensive. And to quote Warren Buffett, I think this is not exactly what he said, but it was along the lines of, I'd rather a lumpy 20 than a flat 10. So better returns tend to come from more volatile stocks. And some degree of volatility is inherent in any asset, other than just sticking your money in a 1-month T-bill. So that's the first thing. Volatility and risk are different, and I love volatility. I'm not so happy about risk, but of course, with some spectacular, some stocks with spectacular potential, you have to accept some risk. I think the biggest difference between you asked about an example. I think the biggest difference in specific stocks between conservative and more aggressive would frankly be the liquidity of the stock. Because typically conservative people are people who might want access to their money at short notice, whereas aggressive people typically are giving you a part of their portfolio and they're not needing or don't think they need to touch it on short notice. And so liquidity becomes much more important in a conservative account.
Interesting, because sometimes for conservative investments, I think actually about locking it up for a period of time because you're going to get a return back.
No, we talked, conservative, mid-risk, and aggressive for us are just the starting point of the conversation. We have conservative people who are giving us all of their money, everything they have, and they're 70 years old, and it's not an awful lot of money, and they're not earning anything else apart from Social Security. Well, clearly you manage that account differently than the 40-year-old who gives you his money and just a skittish kind of person, is just afraid of volatility. You manage those differently. And again, a conservative person might want regular withdrawals from the account, or as you say, they might say, I'm going to lock this up for 30 years till I retire. So I'm not touching it. So you manage all of those different things differently.
I want to ask you now something which people often ask asset managers. The U.S. markets have performed quite well the past couple of years. The S&P 500 currently up about 25% for the past 12 months. The Nasdaq up 30%. This can be both a boon and a bane to asset managers. I mean, on the one hand, it makes it easier to perform well when the markets are up. But on the other hand, it can be pretty hard to beat a 25 to 30% return. So how do you do it? Historically, how do your investments perform compared to the overall market?
Yeah. Well, we can't talk about specific investment. I mean, I'm happy to send that performance to anyone who wants it, but I think it can be misleading to talk about, performance without looking at the whole picture. I would say, generally speaking, I think it's fair to say that our global accounts, whether they're conservative or aggressive, have underperformed the broad market, particularly the US market, in the last several years. And that is because I think we're a little more cautious than what I see in the S&P. We've outperformed the global index many years. And if you go back 40 years, we've outperformed a lot. But I'm just talking about the last few years when the S&P has moved up so dramatically. And frankly, in my view, the valuations have become extreme, and they've been extreme for a while. Just because valuations continue to get higher and the market continues to move higher does not necessarily mean that you were wrong to stand aside when they looked high to you. Our resource accounts typically have outperformed the benchmark on any time frame you care to look at. But the global stocks, the global accounts are a little more difficult. I think, frankly, just because the market is so expensive, and I don't like investing in things when they're expensive.
Well, that's a good bite right there. A good summary, a good tip for sure. No one wants to buy when things are too high. Listening to your talk and reading a bit of what you've written, you emphasize the importance of being contrarian, not following the herd. What would be an example right now of how you're contrarian, of how your strategies are contrarian?
Two things, I think. One would be, as I say, the gold stocks or commodity stocks generally. I mean, commodity stocks are trading relative to the S&P at basically a 100-year low. Now, none of us we don't need relative performance, and relative valuation is not the prime criterion for me. But nonetheless, that shows you how extreme the valuations have become. And I mentioned earlier that I gave the example of Agnico, but many of the large mining companies are trading at valuations that are close to 10 and 20-year lows. So that's definitely, and then you look at the sentiment. When I got into the business, and even in the 90s, 2000s, 2010, virtually every mutual fund you cared to look at had some exposure to gold, whether it was a US large cap or an emerging market fund or whatever it was. They all had some exposure to gold in there. You look today, and other than dedicated gold funds, there's literally a handful, like the First Eagle funds that have gold. But most mutual funds in the US have zero exposure to gold. So that's definitely a very, very contrarian investment right now. I think the other one where might be considered contrarian is we've been investing fairly heavily in China and Hong Kong. I don't invest in Chinese stocks on the Chinese stock markets, but Chinese companies trading in Hong Kong, which of course is a much more liquid, much more open, better regulated market. So yeah, I've been investing a lot, and as you know, Hong Kong and China stocks are trading up until the last couple of months. They've been trading at multi-year lows,
Yeah, the
and the
Hang Seng Index
valuation's
is
just extremely good.
the Hang Seng Index in
Right?
Hong Kong definitely been having a rough couple years, no question about that. I remember
Yeah,
when it was trading up, above 30,000, and now I believe it's around 18,000. So
yeah. Well,
yeah, there are
and
definitely some China
anytime,
bulls out there, but it's
anytime.
interesting to hear that you're one of them.
Yeah, and there's obviously reasons why. There's reasons why Hong Kong and China stocks are inexpensive. There's reasons why gold stocks are inexpensive. Someone, I forget who it was, I wish I could remember, sorry, but someone said anytime you buy a stock as a contrarian, you must feel uncomfortable. If
Hmm.
you're not uncomfortable buying it, it's really not a contrarian investment. And there's a lot of truth in that because when you see something, Hong Kong's a good example. I mean, I struggled. Do I really want to buy this? Look at all the risk, look at the risk. But everybody knows the risks, but people don't see the potential, I don't think.
That's really fascinating. Adrian, thank you so much for walking us through your asset management strategies, for talking about contrarian investments, about gold, about China, Hong Kong. Really interesting. Hope to welcome you back another time to talk more about the markets.
Well, I'd love to, and thank you very much.
We've been speaking with the head of Adrian Day Asset Management, Adrian Day, and you've been watching Global One Media Stocks to Watch. I'm Michael Suardo.